The goal with the Beyond Your Money podcast is to discuss various financial planning topics, investment topics, and economic topics that are timely and relevant and hopefully applicable to your own financial plan, while also taking time to discuss matters that go beyond your money. As we start that journey, we're going to have a slew of knowledgeable guests, economic speakers, investment industry liaisons, other financial advisors and administrative staff, and product experts, all with the intent to educate and empower the audience with the goal of helping you get more comfortable and more engaged with your overall financial picture so that you can start taking control of your complete financial well-being. With it being the first show back, I was thinking about going a number of different directions, whether it was an economic update or a discussion about a particular financial planning topic, or an overview of the various macroeconomic events that are happening around the world. But in the end, I figured we'll get to all that in the future show. Instead, for this relaunch, I decided to go a different direction and bring in Client Service Associate Mary Lynn Meister to help discuss and address the most commonly asked questions that we get in our practice day to day. Mary Lynn, thanks for joining us.
Of course.
All right, so Mary Lynn, let's dive right in. What's one of the first questions we get asked on a daily basis?
One of the biggest ones is, what is comprehensive wealth management? Can you explain?
Yeah, so comprehensive wealth management basically means that we as advisors help our clients with everything that pertains to their financial well-being. A lot of brokers, and that's the true sense of that word, brokers, will do the investments for their clients. And that's really it. You give them your money, and ultimately they invest it for you. As a comprehensive wealth manager, what we do is we talk about the various aspects of your financial well-being. That can include cash flow and debt management, investments, and there's a whole slew of different investments we talk about with our clients. Obviously, brokerage accounts, individual or joint accounts, 529, college savings plans, retirement, IRAs, you name it. So investments are a key part of that. Retirement planning is a huge aspect of comprehensive wealth management. So that would be, just saving for retirement, talking about retirement income, cash flow considerations, that sort of thing. And then we also talk about the peripheral aspects of financial management, and that's where I think we differentiate ourselves from just brokers. In comprehensive wealth management, we also address insurance needs, estate planning, and tax planning. And all 6 of those different pillars, we address all of that, and that was really what comprehensive wealth management's all about.
A total package.
The total package.
Another good question that we get is, how do you engage with a financial advisor? So how would a client engage with you? So
this is a great question. A lot of people kind of have, a reluctance to engage with a financial planner. Maybe they don't think that they're worthy of it, or they don't have enough money, or they don't have enough experience, and that's a huge misconception. So in order to engage with a financial advisor, you just have to make a call. Right? Just call us. Usually what happens is we have an initial discussion. That could be 5 to 10 minutes where we just get to know a little bit about you and what we're doing. We ultimately then kind of progress into what I call the fact-finding stage. And that could be a meeting in and of itself. That could be a Zoom call or a phone conversation. But that's where we get the data. Right, we typically ask for statements in that stage of the game. We try and figure out what your goals are, what your aspirations are, what your time horizon and risk tolerance is, and then ultimately, once we figure out who you are and where you're trying to get, we then figure out, can we provide value? Right? Can we help you get from A to B? And if it's a fit, then we engage in the next conversation, which is a proposal, where we show you the financial plan that we've built for you. We talk about what we're going to do, X, Y, and Z. And then from there, if that's something you're interested in, we execute.
Open the accounts and get it going.
That's right.
A good question. Do you need $1 million to work with an advisor?
Yeah, somewhere along the line, that $1 million was a bogey that someone just made up, or perhaps there are some firms that say you have to have $1 million to invest before we'll even engage in a conversation. That's really not true for us, certainly, and for many financial advisors, that's not true. Really, what it boils down to is what assets do you have? We have to have some money to manage in order to engage with a financial planner, but what do you have, and what are you trying to do? What are you trying to accomplish? And then we match our services and our value proposition to that. And if we can help you and we can provide value, we can engage. You don't need $1 million. We have plenty of clients that don't have that. We have a lot of children of clients that really don't have much at all.
Just starting out.
And they're just starting out, exactly. And ultimately, our job is to help you grow that wealth, and hopefully at some point
Maybe
you
you'll get
get
$1 million. Yeah.
Exactly right.
Do I have to be retiring or retired to work with a financial advisor?
Another major misconception in the industry, the answer is no. As I kind of hinted at before, we have a lot of clients that are either young and just getting started or are accumulating wealth and are at the early phases of their financial journey, so to speak. And so no, you do not have to be retiring. We can engage with clients that are, really at any age. It's just really about what you're trying to accomplish and whether or not we can help you.
Are annuities good or bad?
So, this is a a hot button topic. Annuities are neither good nor bad. Okay, they are a tool. They're a tool in the toolbox, and they're not good for everybody. They're not right for everybody, but they're a tool. And so, what we talk about when we're dealing with clients and annuities in particular, we try and figure out why they are even considering annuities. We want to make sure that they understand what they are, how they work. There's different types. There's probably 4 or 5 major different types. There's dozens of insurance companies that provide annuities, and there's hundreds of different annuity contracts that are available. And so our job with the client is to figure out why you're thinking about an annuity. Is it for income purposes? Is it for protection? Is it for leverage growth? Because annuities do different things. And so it's our job to figure out where you're trying to get and why you've brought up the topic of annuities, or, should I use and recommend an annuity to a client? And then from there, we narrow it down. Not every client needs an annuity. Right. It's not an end-all, be-all. We do run into competitors. That's all they do is annuities. But ultimately, it's a tool in our toolbox that we pull out if it's the right solution for that particular client.
And we do have quite a few that have the annuities.
Absolutely.
And again, their profile.
It fits their profile, whether it's protection. That seems to be most of the annuities that we use in our practice is for protection, and income, I would say, is the other one. And again, before we use annuities in our practice with a particular client, we want to make sure that it's appropriate, that it's the right recommendation, that they fully understand the products and the rules and the obligations. Right. Some annuities have costs, some annuities have surrender periods that are very important. And so we would go through all of that before we even made an annuity recommendation. So they're not good or bad. It's just a tool in the toolbox.
Okay. Another really good question that we get is, what are the fees, and how do you get paid as an advisor?
Yeah, it's funny that a lot of people think that's the first question that gets asked. A lot of times clients feel funny even asking it.
Right.
So I make the point in my business and in my practice when I'm talking with a prospective client to bring that question up, even if they don't ask it. We make sure that they understand, how do you get paid? Okay, right. What do you do? So there's really 2 main ways that advisors in the industry get paid. There's the commissioned approach, or sometimes that's called the brokerage approach, and then there's the advisory approach, which is also sometimes called the fiduciary approach or fee-based. Okay, so those are the 2 main ways advisors get paid in the industry. Commission's pretty easy to understand. I call it the old school way of doing business. Right. That's transactional. When there's a buy or a sale, that generates some sort of commission. Okay, or a broker, right? Think of a broker. You give your money to a broker, they buy something with it. So there's that commissioned type of relationship, transactional. We'll call it the new school way of doing it. It's not new school. It's been around for decades, but it's certainly the way the industry is moving, and that's advisory. In an advisory approach, advisors get paid based off of the assets that they're managing, and that's usually an asset-based management fee. Typically, it's an annual fee that's charged quarterly. That's how we operate here with our firm. Right. But within that type of relationship, that advisory fee pays for everything. It pays for the investments, the transactions, the trading costs, the ticket fees, all those types of things. It covers the planning that we're doing for clients, the investment and the retirement planning, the college savings discussions, things like that. That also covers all the peripheral conversations we're having, whether that's estate, tax, insurance planning. All those different conversations, the resources, the research, the analyst's opinions, things like that, that's all encompassed in the advisory fee that the clients are being charged. So the vast majority of our clientele fall into that second category, the advisory approach. I just happen to think, and this is my opinion, but I just happen to think your goals and your objectives are aligned better with the client in that type of approach. Because if you think about it logically, if we are getting paid a percentage of the assets under management, you as the client, you obviously want your money to grow, right?
Exactly.
And if we are getting paid a percentage of those assets, guess what happens if we get your money to grow? We make more money, right? And so our objectives are inherently tied together at the hip when we are engaged in an advisory relationship, advisory relationship. So when I'm engaging new clients, we look at both options, but more often than not, we tend to go with the advisory approach. And that's truly the way that the industry has gone over the last couple of decades.
Well, in regards to that point, we get a question. Are you a fiduciary?
Yeah, so that's that's another hot button topic. That's a word that's out there that seems to be thrown around quite a bit. There's commercials, there's radio ads all about fiduciary, right? Are you a fiduciary? Is your advisor a fiduciary? And the short answer is maybe. When you're engaged in a commissioned or a brokerage or a transactional relationship, and this might be surprising, but technically you are not operating in a fiduciary capacity. However, when we or anyone is operating in an advisory capacity, we are fiduciaries. And fiduciary just basically implies that we as advisors have to operate in the best interests of the client. We have to put the client before our best interest, before our firm's best interest. It's client first. And so that's what a fiduciary is. It's putting the client first. And we tend to do that in every relationship, but when we are engaged in an advisory capacity, we are legally a fiduciary in that sense.
Okay, makes sense. Can you tell us what's your investment philosophy?
So this is another interesting question that we get quite a bit. So a lot of people are out there when they're shopping for advisors or looking for someone to manage their money. The question is, can you beat the market, right? And the short answer is, who knows? I'm not Warren Buffett, nor do I pretend to be. It's very, very difficult to beat the market to the upside year after year. Okay, it's if there's anyone out there that says they can do it, we'll see. Even the best money managers tend to be on the bad side of a trade every once in a while. So it's very, very difficult to beat the market to the upside year after year. Instead, when I'm managing money for my clients, what I try to do is I try to focus on diversification and risk management. Okay, so we try and figure out risk mitigation for clients, time horizon. Are they more conservative? Or are they more aggressive? We try and figure out what type of portfolio they should be in. And then when I'm putting investments in place, we try to pick managers and investments that do better to the downside. Okay, because ultimately, instead of trying to beat the market to the upside year after year, I find that it's a lot more prudent to instead try and beat the market to the downside, meaning lose less when the market's going down. Because over time, if you lose less, you win over time.
Right.
And that's really my investment philosophy. Don't try and get hamstrung with trying to beat the market year after year. Don't try and beat the market every year. Instead, try and lose less when the market's going down. And if you think about that logically, if the market does go down, which it will, okay, it doesn't go straight up forever. When the market's going down, if you don't go down as much, you have a shallower hole to dig out of when the market rebounds, which it usually does. And so again, my investment philosophy is not to try and beat the market. Instead, try and beat it to the downside because you win more by losing less.
Makes sense. How do you manage portfolios? Do you trade every day? Is there a schedule? How do you do that?
Yeah. Another good question. So ultimately, when we are in our advisory capacity, we'll talk about that. What we are doing is we're managing models mostly. Those models are designed to, I call it the all-star team. I was a baseball player, and so I tend to use a lot of baseball analogies in my practice. So what I do is I try and find the best managers and the best, whether it's a mutual fund or an ETF or a UIT or even stocks or individual bonds, I try and find the best players in every position that we need to cover. And so when we do that, we do a lot of analysis, a lot of research on the front end. We know what we're buying. We know the managers that we're using in each of those positions and why they're there. And so inherently, because of all the research and all the things that we're doing on the front end to put the players into the positions, we tend to have very low turnover in our portfolios. And so the answer is no, we're not trading every day. We are not day traders. I actually have turned people away to our practice who are interested in day trading. If you're day trading, you have to be at your computer all day, every day, which means I can't meet with clients. We can't engage with families and businesses, and we can't help our clients with their other financial planning topics. So we don't day trade. Instead, what we do is we figure out what type of portfolio these clients should be in, whether it's moderate, conservative growth, aggressive growth. We figure out where they should be, and then we build models that are appropriate to that client. Now, those models, they do change. They are what we'll call active. So we are monitoring the positions, the players in the positions. If someone's in a slump, for example, we'll give them the benefit of the doubt for a while. I typically use 2 quarters as my watch window. And if the player needs replaced, we can pull them out and put in the second string. And we have a lot of people on the bench waiting to get into the model. But we, with our portfolios, as far as trading, we have at least quarterly rebalancing. That's how I manage money. Everyone does it differently, but at least quarterly rebalancing. And then throughout the year, just depending on what the market's doing or what headline of the day is creating stir in the market, or if there's an opportunity or a dislocation in the market, what we will do then is make trades throughout the year. So it's very dynamic. We have discretion to make moves as we see fit based off of what the market's doing, but it's not daily. It's not daily trading. It's based off of market conditions and rebalancing.
And lastly, the clients want to know, how often do you meet with them? Is there a schedule? How do you do that?
There is a schedule, and the clients that we engage, they kind of are familiar with this schedule on the front end, so all expectations are met. But we insist that we meet with our clients at least once a year face-to-face. And face-to-face means either in person, physically, but that also means either a phone call or a Zoom call. We have clients, I believe we're in over 30 states. We're licensed in over 30 states right now. So we have clients all over the place, 3 or 4 different countries. So you can't meet face-to-face physically all the time. But we have at least one comprehensive review meeting a year. Some of our clients, maybe 2. But what I found early in my career is if you have 3 or 4, a lot of people like that idea of quarterly meetings. Not much was changing. And so at least once a year, face-to-face, more comprehensive. And then throughout the year, whether we're doing rebalancing trades or something comes up with regards to the market that warrants a change in a client's portfolio, or things happen on the client side. So if something happens on your side of the table as a client, we say, hey, call us. The analogy I like to use is it's kind of like a dentist's office. You have your cleaning once a year, but if your tooth hurts 3 months after your cleaning, you're not going to wait.
Right.
You're going to call us. We're going to get you in. We're going to have another review meeting. So short answer to your questions, we're seeing our clients at least once a year face-to-face, and then we're probably in touch with our clients another half a dozen to a dozen different times throughout the year, whether it's phone calls, Zoom calls, emails.
Or whenever they feel necessary, they want to come in and see us.
It's an open door policy, and that's really where the relationship takes off, is when it's it's a group effort, right? It's 2-sided conversations. It's not just me lecturing. It's not just me, telling you what to do. We need to have that open communication. So, short answer is we're always in front of our client. All right, well, Mary Lynn, thank you. I appreciate it. Those are, some of the most widely asked questions that we get on a daily basis. So I appreciate you, talking about it with us. Again, thank you for tuning in to the first show, the relaunch of Beyond Your Money. I'm really excited to get this going. We're going to have a lot of different shows coming up. We're going to have experts from different areas of the market. We're going to have some of our colleagues, whether it's financial advisors, client service associates. We're going to have industry experts on the show, so I'm really excited about that. We're going to talk about a whole slew of different topics. But again, my goal with this show is to help educate. It's going to help to empower. It's going to help you get more engaged with your overall financial well-being, because I truly feel as a money manager and as a financial advisor that you should understand what we're doing to a certain extent. So again, we appreciate you tuning in, and keep in mind, it's your money, it's your life. Take control.